Welcome, curious minds, to the deep dive. Today, we're embarking on a truly fascinating journey into the human side of wealth, greed, and happiness.
Yeah, we're setting aside the complex spreadsheets, the jargon.
Exactly. Our mission in this deep dive is to explore how our behavior, our emotions, and, our unique life experiences profoundly shape our financial destinies, often in ways we barely realize.
That's right. We're drawing from Morgan Housel's incredibly insightful work, The Psychology of Money, to unpack some timeless lessons.
Hmm.
It's a compelling look at why doing well with money has far less to do with how smart you are, your IQ,
Right.
and everything to do with how you behave. We're going to uncover some, frankly, surprising facts that challenge conventional wisdom.
And hopefully offer you a shortcut to being well informed about yourself and your money.
That's the goal.
So let's unpack this. Our source material today is, well, it's a treasure trove of stories and observations. They reveal the often hidden forces at play in our financial lives.
Yeah, get ready for some serious aha moments as we dive deep into what truly drives financial outcomes.
Okay, so first section, the human element of money. Why behavior trumps intellect. And here's where it gets really interesting right from the start. Finance. It's unique, isn't it?
It really is. Unlike fields like medicine or engineering, where, years of formal training and technical skill are absolutely essential for success.
Definitely.
Financial outcomes often seem completely decoupled from traditional intelligence or even like a top-tier education.
It's wild when you think about it.
Indeed. Housel opens his book with two striking, contrasting figures that perfectly illustrate this exact point.
Okay.
On one side, he introduces us to a brilliant tech executive, a certified genius, who, in his 20s, designed and patented a key component in Wi-Fi routers.
Wow. Okay. So clearly smart.
Extremely smart. This individual started and successfully sold multiple companies, accumulating millions. Yet, despite his intellect, he had this incredibly insecure and almost childish relationship with money. He'd carry around thick stacks of hundreds, just flaunting his wealth, often while, intoxicated.
Oh, boy.
And in one notorious instance, he gave a valet thousands in cash to buy gold coins.
Gold coins.
Gold coins, which he then gleefully threw into the Pacific Ocean, skipping them like stones, just for the sheer fun of it.
You're kidding. That's something else.
Unsurprisingly, this kind of behavior, driven by ego and just a total lack of behavioral control, eventually led to his bankruptcy.
It's quite a story of self-sabotage, isn't it? Just throwing it all away.
Literally throwing it away. And then, contrasting that, there's Richard Fuscone.
Ah, yes, the Harvard-educated Merrill Lynch executive.
Exactly. Retired at 40, lauded for his business acumen, leadership skills, and sound judgment. Sounds impressive, right?
Totally. Ivy League, top finance firm.
Yet he too ended up bankrupt. Excessive debt, illiquid assets. He lost his sprawling 18,000 square foot mansion.
So the genius tech exec and the Harvard finance guy both end up broke.
Precisely. And what's truly fascinating here is the stark contrast to Ronald Read,
The janitor from Vermont.
the humble gas station attendant and janitor from rural Vermont. Read passed away in 2014 at 92. He had absolutely no formal financial education whatsoever.
None.
None. He bought a modest two-bedroom house for $12,000 at age 38 and lived there his entire life. He just saved what little he could.
Oh, okay.
And, crucially, invested it consistently in blue-chip stocks for decades, just quietly plugging away.
And the results.
Upon his death, he quietly left an $8 million fortune.
$8 million from a janitor's salary.
$8 million, with millions bequeathed to his local hospital and library. Now think about that. In almost no other industry could someone with such a limited formal background so dramatically outperform individuals with the best education, the best connections.
It really hammers home Housel's core premise, doesn't it? That financial outcomes are less about math smarts and more about behavior.
Exactly.
Yeah.
It speaks volumes about how your personal experiences with money, even if they represent, 0.0000001% of what happens globally,
Right. Tiny fraction.
they still form the overwhelming majority, maybe 80%, of how you think the world works when it comes to finance.
So it's not just what you know intellectually, but what you've lived through, how that shapes your perspective.
That's the key.
Like, someone who lived through the Great Depression might have that almost indelible scar from it, making them inherently risk-averse.
Terrified of stocks, maybe.
While someone who only read about it in a textbook might be far more comfortable with market fluctuations. That's what you mean by our personal histories being so persuasive?
Precisely. People don't make financial decisions in a vacuum. based purely on like superior information or rational economic models. They make them based on their unique experiences, their deeply held beliefs, their personal goals, their own forecasts,
All filtered through their own lens.
all filtered through their specific historical context. This is why equally intelligent people can disagree so fundamentally on investing strategies or economic trends. We literally see the financial world through different lenses.
Does that make sense?
Even something as random as your birth year can profoundly impact your risk tolerance. Think about it. If you were born in 1970, the S&P 500 nearly decoupled, inflation adjusted, during your formative teens and 20s.
Wow. Okay, so you'd think stocks only go up.
Pretty much. Yeah. But if you were born in 1950, the market literally went nowhere, inflation adjusted, during those same crucial years.
So you'd be much more skeptical.
Completely different mental models of how the stock market works.
Oh.
And neither person is crazy. They're just products of their experience.
And this isn't just about big historical events, is it? It extends even to seemingly simple, everyday choices.
Absolutely.
Like buying lottery tickets. To an outsider, that might seem incredibly irrational, especially for someone with limited income. But Housel's nobody's crazy principle suggests there's a logic there. How does that apply?
That's a really powerful example because, yeah, on the surface, it does seem illogical. Spending money on lottery tickets when you're struggling, maybe spending what could be an emergency safety net. But as Housel points out, from their perspective, it might be the only tangible hope they feel they have of ever escaping their current financial situation.
So it's like buying hope.
It could be. They might be thinking, look, I'm broke, I'll probably always be broke, but this lottery ticket, however tiny the odds, is the only shot I have at a truly life-changing outcome. You don't have to agree with the reasoning.
No, but you can understand the feeling.
You can understand the underlying motivation.
Yeah.
Very few people make financial decisions purely with the spreadsheet. They make them around the dinner table or in a company meeting where personal history, ego, pride, maybe some weird incentives, they all combine into a narrative that just makes sense to them.
And it's worth remembering how new so much of this financial world is.
Oh, incredibly new. Retirement as a universal right that's maybe 2 generations old. Before WWII, most Americans just worked until they died.
Wow.
The 401k is just over 40 years old, index funds less than 50. Widespread consumer debt really only took off after WWII.
So we're all kind of winging it with these modern systems.
In many ways, yeah. We're improvising our way through these remarkably modern financial systems, which is exactly why our individual psychology plays such a critical role.
Okay, this idea of nobody's crazy leads us right into the twin forces of luck and risk. Housel argues these are often overlooked in financial success stories, partly because they're so hard to quantify, right?
Exactly. And partly because they imply that success isn't entirely self-made, which can be an uncomfortable truth for a lot of people.
Yeah, nobody wants to admit luck played a huge part.
It's tough. But think about it. For every Bill Gates, there's a Kent Evans.
Okay, explain.
Gates, undeniably brilliant, hardworking, driven,
Absolutely.
also had the 1 in a million luck of attending one of the only high schools in the world, Lakeside School, with access to an advanced computer way back in 1968.
That's incredible luck. Most universities didn't have that then.
Exactly. Most university graduate schools didn't have a computer as advanced as what Bill Gates had access to as an 8th grader. That was a massive stroke of luck.
Yeah, and Kent Evans.
His friend, just as brilliant.
Yeah.
Just as ambitious. They even co-wrote a complex program for their school together. Gates genuinely believed they would have gone to college together, maybe even been partners in Microsoft, just like he was with Paul Allen.
What?
But Evans tragically died in a mountaineering accident before graduating high school.
Oh, no.
A 1 in a million risk.
Yeah.
It's the same force, luck, and risk. The same magnitude, just acting in completely opposite directions.
Wow. That really illustrates it.
It shows that success and failure are rarely as good or as bad as they seem, precisely because of this invisible influence of luck and risk. Even Nobel laureate economist Robert Shiller admitted the one thing he wished he knew more about investing was the exact role of luck in successful outcomes.
Because it's hard to measure and maybe a bit impolite to bring up.
It feels impolite, so we often just implicitly ignore it when we analyze financial performance or tell success stories.
So when we look at someone like, say, Cornelius Vanderbilt or John D. Rockefeller, their massive success involved at times overtly flaunting laws or ruthlessly crushing competitors. It's tempting to praise their visionary ruthlessness. but it becomes incredibly difficult to tell if that was pure skill or if it was simply avoiding the unfortunate side of risk that might have landed someone else in jail.
That's the point, exactly.
Mm.
Vanderbilt once famously said, "What do I care about the law? Haven't I got the power?" And,
Mm.
well, he did, and it worked out for him. But was that skill or just dodging the bullet of risk?
It's impossible to know for sure.
The line between being audacious and being reckless can be razor thin, and it's often only truly visible in hindsight. Many financial outcomes, good and bad, are profoundly influenced by factors far beyond our conscious decision-making.
We like simple stories, though.
We love simple, linear explanations. Do exactly what she did to get rich. But we often fail to account for the powerful, invisible role of randomness.
So the goal isn't to deny individual effort or brilliance.
Not at all. But is to acknowledge that outcomes are a complex mix of skill, effort, and external factors. That makes it incredibly hard to perfectly emulate success or avoid failure just by following a formula.
Even the greats acknowledge it.
Benjamin Graham, the father of value investing, Warren Buffett's mentor, openly admitted that most of his own investment success came from owning a huge chunk of Geico stock.
Which broke his own rules, right?
Broke almost every diversification rule he himself had established. So was that a stroke of luck or a supremely astute, rule-breaking decision? It's genuinely not easy to distinguish.
So, with luck and risk playing such a significant role, what can we as listeners actually take away from this? How does it help us improve our financial lives?
Well, I think it means we should focus more on broad, repeatable patterns of success. Things like saving consistently, being patient, having a long time horizon.
Rather than trying to perfectly replicate extreme outlier successes.
Exactly, because those are likely heavily influenced by immense luck. And crucially, we should organize our financial lives in a way that ensures a single bad investment or a single economic downturn or missing one financial goal doesn't completely wipe us out.
Build in that resilience.
Build in resilience. It allows us to keep playing the long game until the odds eventually fall in our favor. Failure can be a terrible teacher if it convinces intelligent people their decisions were awful, when sometimes it just reflects the relentless, unpredictable reality of risk.
This brings us to a really powerful yet deceptively simple concept: enough.
Ah, yes, enough.
It sounds so straightforward, but Housel presents this idea with a profound punch. He tells the story of Joseph Heller, the author of Catch-22.
Great story.
At a party hosted by a billionaire hedge fund manager, the manager points out he made more money yesterday than Heller made from Catch-22 in its entire history.
Oof. That's got to sting.
Right. But Heller's reply was legendary. He said, "Yes, but I have something you will never have." The billionaire asks what? Heller says, "Enough."
Boom. Such a profound statement. Cuts right to the core of financial contentment. And Housel demonstrates the dangers of lacking enough through some pretty extreme examples.
Like Rajat Gupta.
Yeah, Rajat Gupta, former CEO of McKinsey, no less. Orphaned as a teenager, rises through the ranks, amasses a $100 million fortune by 2008, an unfathomable sum for most people.
Absolutely. Set for life multiple times over.
You'd think. Yet, he desperately wanted to be a billionaire. And he engaged in insider trading, specifically leaking information about Warren Buffett's $5 billion investment in Goldman Sachs during the crisis.
And the consequences.
Imprisonment, ruin, effectively throwing away unimaginable wealth, immense prestige, his freedom, all because $100 million wasn't enough.
And then there's Bernie Madoff.
Another stark example. Before his infamous Ponzi scheme, Madoff actually ran a highly successful and legitimate market-making business.
Really? I didn't realize that.
Yeah, it made him genuinely rich, earning maybe $25 million to $50 million per year. Legally.
So why the Ponzi scheme, then?
That's the core question Housel asks. Why would individuals already worth hundreds of millions of dollars risk everything for more? Clearly wasn't about survival. It was about insatiable greed. They squandered unimaginable wealth, prestige, freedom, because they simply didn't have enough.
It's like Warren Buffett said about the long-term capital management guys.
Exactly. Buffett said, to make money they didn't have and didn't need, they risk what they had and what they needed. And that's foolish. It is just plain foolish.
So it seems like the comparison trap is a huge part of this, doesn't it? Keeping up with the Joneses, but on a massive scale.
Oh, absolutely. It's social comparison dialed up to 11. Housel uses the example of a pro baseball player earning, say, $500,000 a year. Objectively rich, right?
Definitely.
But compared to Mike Trout's $430 million contract, they might feel comparatively poor.
That's crazy, but I can see how that mindset works.
The ceiling of social comparison is so astronomically high that virtually no one can truly reach it. It's an unwinnable battle.
Hmm.
The hedge fund manager earning $340 million in a year still looks up at the guy who made $770 million, or Bezos, or Buffett.
So the only way to win is not to play.
The only way to win is to not fight it at all, to accept that you might have enough, even if it's less than those around you. It's like that Vegas casino dealer saying, the only way to win in a Las Vegas casino is to walk out as soon as you walk in.
Knowing you're enough is about leaving the table.
Exactly. Getting off the hamster wheel of wanting more.
That really challenges the conventional wisdom of always striving for more, doesn't it?
Hmm.
But how do we differentiate enough from simply settling or, missing out on genuine, valuable opportunities?
That's a fair question. It's not about forsaking opportunities or living in scarcity. Housel stresses that enough means recognizing that some things are simply never worth risking, regardless of the potential financial gain.
Like what?
Your reputation,
Yeah.
your freedom, your independence, your family, your friends, love, your happiness. These are the truly invaluable assets.
Yeah, the things money can't buy or can't buy back once they're gone.
Precisely. Raja Gupta's post-prison statement was actually quite tragic. He said he learned not to get too attached to anything,
Yeah.
your reputation, your accomplishments, or any of that. He completely missed the lesson. Those are the things that are invaluable.
So knowing when you have enough is the absolute key to preserving those irreplaceable aspects of your life.
It's the only way. It's the hardest financial skill, but arguably the most important.
Okay, so we've talked about the dangers of greed, the power of enough. Now, let's shift to an incredible force in finance that Housel calls confounding compounding.
Compounding. Simple, yet so powerful.
It's one of those concepts that appears simple on the surface, but is actually deeply unintuitive to our linear thinking brains.
Right. Totally. Our brains just aren't wired for exponential growth. Compounding is, at its heart, about small growth serving as fuel for even greater future growth.
Housel uses the analogy of ice ages.
Yeah, how tremendous, seemingly impossible results can stem from tiny starting points, growing exponentially over vast periods. For centuries, scientists couldn't figure out ice ages without imagining some huge, sudden force. They missed the slow, continuous buildup.
Like with investing.
Exactly like investing. Many books attribute Warren Buffett's incredible $84.5 billion fortune solely to his investing skill, which is immense, obviously.
Of course.
But the crucial, often overlooked point is that an astonishing $84.2 billion of that was accumulated after his 50th birthday.
Wait, say that again? $84.2 billion out of $84.5 billion.
That's right. And get this, $81.5 billion came after he qualified for Social Security in his mid-60s.
That's staggering. So his real secret isn't just skill?
It's time. Immense amounts of time allowing that skill to compound.
So it's not just how good he is at investing, but the sheer number of decades he's been consistently good.
Precisely. If he'd started at 30 with, say, $25,000 and retired at 60, a typical successful career, even with his phenomenal 22% annual return,
He'd still be rich, right?
he'd have about $11.9 million, which is fantastic. But it's a staggering 99.9% less than his actual net worth.
That difference is just mind-blowing. It really shows the power of time.
It highlights the truly counterintuitive nature of exponential growth. Take Jim Simons, the brilliant hedge fund manager behind Renaissance Technologies.
With incredible returns.
Astonishing. 66% annual return since 1988. That's 3 times Buffett's rate.
So he must be way richer than Buffett then.
Nope. He's actually 75% less wealthy than Buffett.
How is that possible with triple the returns?
Because he only started investing seriously in his 50s. The compounding period for Buffett was more than twice as long. If Simons had achieved his insane 66% return over the same decades Buffett has been investing, well, the number would be so astronomically large, it's practically meaningless to even say it.
Billions upon billions upon billions.
Trillions, probably. The point isn't the exact number, but the sheer, almost unimaginable power of sustained exponential growth when given enough time.
It's like how data storage went from kilobytes in the 70s to terabytes now. It just explodes.
Exactly.
We intuitively think linearly. If I ask you to calculate 8 plus 8 plus 8 9 times, easy. But 8 to the power of 9, our brains kind of short circuit.
They really do. Which means we frequently overlook the staggering potential of compounding. We look for complex, active solutions instead.
When just being patient would yield far greater results.
Often, yes. Even Bill Gates himself, back in 2004, questioned why anyone would ever need a gigabyte of storage for email. He was anchored to the old idea that storage must be conserved, completely missing the exponential growth just around the corner.
That's funny in retrospect.
Housel suggests the most powerful book on investing might just be one page with a simple chart of long-term economic growth, titled, "Shut Up and Wait."
Ah, I like that.
The key insight is that sustained reasonable returns over the longest possible time will nearly always outperform chasing the highest short-term gains, which are often unsustainable and stressful. Too much effort goes into chasing tiny percentage points when simple patience would yield exponentially greater results.
Okay, building on this idea of enough and the power of time, Housel then turns our conventional understanding of money upside down with another really counterintuitive concept. Wealth is what you don't see.
Ah, yes. This is a big one.
It feels almost contradictory, doesn't it? We're so used to judging success by what's visible.
It absolutely is. We often fall into the trap of judging people's financial success by their visible possessions, the fancy cars, the sprawling houses, the designer clothes.
Right. You see someone driving a Ferrari, you think, wow, they're rich.
Yes, but someone driving a $100,000 car literally has $100,000 less than they did moments before buying it, or $100,000 more in debt.
Good point.
The real wealth is what's hidden. The good car's not bought, the diamond's not purchased. It's the financial assets that haven't yet been converted into visible stuff.
And modern capitalism makes it easy to look wealthy without actually being wealthy.
Incredibly easy. Easy credit, endless consumer options. You can fake it till you make it, or more often, fake it till you break it.
The source tells that revealing story of Roger, the guy the author knew as a valet.
Oh yeah, Roger in the Porsche.
He'd drive these expensive Porsches, then suddenly show up in an old Honda. When asked, Roger just casually admitted his Porsche was repossessed because he defaulted on the loan.
Classic.
All those initial assumptions about him, based purely on what was visible, were completely wrong. The author notes, Los Angeles seems full of Rogers.
It's easy to make those assumptions. But true wealth, Housel argues, is simply unspent income. It's the option value.
Option value.
Yeah, the option to buy more later, or, more importantly, to simply have flexibility and security. When people say they want to be millionaires, they often mean they want to spend $1 million.
Which is, ironically, the exact opposite of being a millionaire.
Precisely. It's like Rihanna's former accountant retorted when she sued him for her financial ruin. Was it really necessary to tell her that if you spend money on things, you will end up with things and not money?
Huh. Apparently, yes.
Apparently, yes, because people often don't grasp this simple, fundamental fact. And this is difficult to learn because wealth is largely invisible. We learn by imitation, right?
Yeah.
But if we can't see someone's savings account balance or their diversified portfolio, how do we truly learn their habits?
Like Ronald Reed, the janitor millionaire. Nobody knew she was wealthy while he was alive.
Exactly. He was nobody's financial role model during his lifetime because his wealth was entirely hidden.
So, given that true wealth is often invisible and our financial worldview is so personal, what are the actionable takeaways for us, the listeners? How does this help us set goals and avoid pitfalls?
Well, it reinforces that many seemingly modest people are, in fact, genuinely wealthy, while many who appear rich are actually living on the edge of insolvency, maybe drowning in debt.
It's a crucial distinction.
It really is. Keep it in mind when judging others' success, but more importantly, when setting your own financial goals. It's hard to learn from what you can't see. That helps explain why accumulating true wealth, the unseen kind, is so challenging for many. It requires a different lens focusing on what you keep, not just what you display.
It's a profound thought that true wealth is invisible. And if that's the case, then saving the act of not spending becomes incredibly powerful, almost deceptively simple, doesn't it?
Deceptively simple is the perfect way to put it.
Housel really drives home that saving is the one factor we truly control.
Absolutely. He argues the creation of wealth has surprisingly little to do with your income level or even your investment returns.
Really? Less than returns.
Much less, he argues, than your savings rate. It's all about efficiency. Think about how the world addressed energy scarcity. Yes, we found more oil, but the bigger impact came from becoming far more efficient with the energy we used. We effectively doubled what we can do with the same energy.
Okay, I see the analogy.
Similarly, creating wealth is about being more efficient with your money. Wealth is simply what's left over after you spend what you get. You can build substantial wealth even without a high income, but you have virtually no chance of building it without a consistent, decent savings rate. It's the bedrock.
So saving isn't just about accumulating more money, but fundamentally about needing less to be happy. Is that the idea?
Precisely. If you cultivate the ability to be genuinely happy with less money, you inherently create a significant gap between what you have and what you want or need. That gap is savings.
And that's more controllable than trying to earn more or chase higher returns.
Often, yes, and often easier. Housel notes it's frequently more valuable to reduce your needs by, say, 3 percentage points than to work 80 hours a week, desperately trying to boost your investment returns by maybe a tenth of a percentage point.
It makes a lot of sense. Less stress, too.
Way less stress.
And this means battling our egos, right? So much of our spending seems driven by external pressures, what we think others expect.
It absolutely does. Spending beyond a certain level of basic comfort and utility is largely a reflection of ego-driven consumption. It's a way to signal status or keep up with perceived peers.
So one of the most powerful ways to increase savings isn't just earning more.
But increasing your humility. When you consider that savings is effectively the gap between your ego and your income, you start to understand why so many people earning decent money still save so little.
It's a daily battle against that instinct to keep up.
It really is. People who achieve lasting financial success tend to genuinely care less about what others think of them. That freedom from external validation allows them to save more simply by desiring less. They're not trying to impress anyone with their spending.
And saving doesn't even need a specific, clearly defined goal, does it? We're often told save for a house, save for retirement, save for a car.
And those are fine goals. But no, saving doesn't always need a specific target. Saving just because is, in fact, vital.
Why, just because?
Because life is full of unpredictable surprises. Housel likens them to financial field mice that can chew through your carefully laid plans. Remember the actual mice that rendered German tanks useless in WWII by eating their electrical insulation? Nobody planned for that.
Great analogy. So savings are like mousetraps.
Kind of. Savings without a specific purpose act as a crucial buffer against these inevitable unknown unknowns. They provide invaluable flexibility and, crucially, control over your time. This invisible return of wealth is immeasurable.
The return you can't put on a spreadsheet.
Exactly. Every little bit of saving is like reclaiming a point in the future that might otherwise have been owned by someone else and giving it back to yourself. The ability to change careers, retire early, or weather an unexpected emergency without panic, that return is truly incalculable. It's the ultimate quiet power.
Okay, moving into navigating the real world. Housel presents this powerful paradox. There are a million ways to get rich, but he argues there's only one sure way to stay rich.
Right, that one way.
A unique combination of frugality and paranoia.
Frugality and paranoia. It sounds intense, but this concept of survival is paramount in finance. Getting rich and staying rich are two entirely different skills.
He uses Jesse Livermore as an example, right?
You know, a legendary stock trader born in 1877, he made the equivalent of over $3 billion in a single day during the 1929 market crash by masterfully betting against the market.
Oh.
Imagine that. His wife and kids were crying, fearing ruin, but he walks in and announces they're fabulously rich.
Incredible timing and skill, or luck.
Probably a mix. But despite this astounding success, Livermore went bankrupt multiple times later in life and tragically took his own life in 1940. He was brilliant at getting rich.
But terrible at staying rich.
Terrible at staying rich. In stark contrast, Abraham Germansky, a real estate mogul, lost everything in the same crash. Maybe even his life. He apparently just disappeared after being seen scattering ticker tape on Wall Street. Total ruin.
It's such a stark contrast in outcomes from the same event.
Indeed.
Yeah.
Now consider Charlie Munger and Warren Buffett. They often emphasize that their enduring success wasn't due to speed, but rather immense patience, staying power.
Survival.
Rick Guerin, a third brilliant member of their early investing group, just as smart as them, maybe even quicker. But he was in a hurry, as Munger put it. During the brutal 1973-74 recession, Guerin was highly leveraged with margin loans. The market tanked.
And he got a margin call.
Exactly. Forced him to sell his Berkshire shares back to Buffett at a ridiculously low price, less than $40 a share. Buffett and Munger, simply by surviving that downturn, by not being leveraged and not being forced to sell, flourished.
Wow. Just surviving made all the difference.
Survival means not being annihilated, not being forced to give up. Compounding only works its magic if you can give your assets years, often decades, to grow. And that fundamentally requires enduring the inevitable ups and downs without being forced out of the game. Buffett and Munger's extraordinary longevity, investing consistently from age 10 to, well, into their 90s. That's what made compounding truly work its wonders for them.
So for us, what does this survival mindset actually look like in practice? What should you be thinking about?
Well, it means not getting carried away by excessive debt, especially leverage, which can force your hand at the worst possible time.
Right, avoid margin calls.
Avoid margin calls. It means having the emotional discipline not to panic and sell your investments during market downturns, just when things look bleakest.
Easier said than done sometimes.
Oh, absolutely. It also means preserving your reputation. That's an invaluable asset. And it means constantly adapting your strategy as the world inevitably changes. You can't just set it and forget it entirely.
It's like Nassim Taleb says.
Exactly. You need to avoid ruin at all costs. Having cash sitting around during a bull market might make you feel foolish, right? Earning only 1% while stocks are roaring up 10% or more.
You feel like you're missing out.
But if that cash prevents you from having to sell your stocks during a deep bear market, the real return on that cash isn't 1%. It could be multiples higher because it prevented a desperate, ill-timed sale that could destroy years of gains.
So longevity, supported by survival, is what truly makes compounding work.
Absolutely. And crucially, the most important part of any financial plan is planning for the plan not to go according to plan, having that buffer.
So, if enough and survival are so crucial, what's the ultimate payoff for embracing these principles? Housel argues it's freedom.
Freedom, yes. Money's highest dividend, he argues, is undeniably the ability to control your time.
How so?
Well, even a small amount of wealth provides the basic ability to take sick days without financial ruin, or maybe to quit a job you hate without having another one lined up immediately.
Like having that cushion.
More wealth allows you the luxury to wait for a truly good job after a layoff, or maybe to accept a lower-paying job that offers more flexible hours or is more meaningful to you.
And ultimately,
Ultimately, it means having the choice to retire when you want, not when you have to. It means pursuing passions rather than just obligations. It's about owning your calendar.
this reminds me of the author's personal story about his investment banking internship back in college.
Ah, yeah, the brutal hours.
Exactly. It was prestigious, well-paying, but the hours were just crushing. And he realized something profound. Doing something you love, but on a schedule you can't control, can feel just like doing something you hate.
That's so true. He only lasted a month in a 4-month internship, even though he actually liked the core work itself. The lack of control was unbearable.
It triggered that psychological reaction.
Precisely. Psychologists call it reactance, that fundamental human desire to feel in control of our own lives. Aligning your money towards a life where you do what you want, when you want, with who you want, for as long as you want. That yields an incredible, immeasurable return.
He uses Derek Sivers' story too, right?
Yeah, the founder of CD Baby. At 22, he saved up $12,000 working a minimum wage job, lived super frugally on $1,000 a month, saved the rest.
Okay.
The real life-changing moment for him wasn't years later when he sold his company for millions. It was when that $12,000 allowed him to quit his day job and become a full-time musician. That gave him complete control of his time. He says he never had a job again after that.
That $12,000 bought him freedom.
Exactly. More valuable in that moment than millions later on.
It seems kind of paradoxical that despite being the richest nation on earth, Americans aren't necessarily happier today than they were, say, in the 1950s when they had far less stuff.
It is a profound observation, and Housel tackles it directly. He suggests it's because while we've certainly used our increased wealth to buy bigger and better things—
Bigger houses, better cars, cheaper TVs.
Right. The average house size has doubled since the 50s. Cars are safer and more reliable. TVs are giant and cheap.
But
We've often inadvertently sacrificed control over our time in the process. Our commutes might be longer, jobs more demanding, stress levels demonstrably higher.
trading time for stuff.
Often, yeah. The wisest people, those who've truly lived it all, consistently emphasize things like quality friendships, being part of something larger than oneself, and unstructured time with their children as the true drivers of happiness, not money or possessions themselves.
Nobody on their deathbed wishes they'd spent more time at the office optimizing their portfolio.
Not a single person in the countless interviews Housel mentions told him they should chase money to the exclusion of all else. The highest dividend money truly pays is the ability to control your time. Full stop.
Okay, our listener, the learner, is probably thinking, this is great insight, but how do I apply all this wisdom in my own financial decisions day to day?
Right, the practical application.
Housel gives us a fantastic guide here. Don't try to be coldly rational in financial decisions. Try to be pretty reasonable.
I love that distinction. reasonable over rational.
Why is that so important?
Because it acknowledges that we are, at our core, emotional, fallible human beings, not perfectly optimized spreadsheets. A purely rational strategy might look perfect on paper, mathematically optimal.
Right, the spreadsheet says do X.
But if it's too difficult, too uncomfortable, too psychologically painful, or too rigid to actually stick to in the real world, it ultimately fails. Sticking with a plan is more important than having the perfect plan you abandon.
He uses that wild story about the syphilis treatment.
Oh yeah, Julius Wagner Jauregg, the psychiatrist who won a Nobel Prize in the early 1900s. He treated syphilis by intentionally infecting patients with malaria to induce high fevers.
That sounds insane.
It sounds insane, but his rationale was sound. Fever helps the body fight infection. It actually worked sometimes, but it was a brutal, dangerous treatment. Some patients died from the malaria.
Yeah.
Yet, technically, it was rational based on the understanding at the time.
But not reasonable.
Definitely not reasonable by today's standards.
Mm-hmm.
And think about fever phobia today. Science shows fevers can be beneficial, reducing viral replication maybe 200-fold.
So we should just let fevers run their course.
Rationally, maybe sometimes. But do we? No. Because fevers hurt. People don't want to hurt. Taking Tylenol is a reasonable, not purely rational choice. We go to the doctor to stop hurting, not necessarily to embrace what might be biologically optimal, but extremely uncomfortable.
And this applies directly to finance.
Directly. Harry Markowitz, who won a Nobel Prize for his groundbreaking work on modern portfolio theory, a purely rational mathematical approach to investment.
The pinnacle of financial rationality.
You'd think. He famously split his own retirement investments 50-50 between stocks and bonds.
Just 50-50. That doesn't sound mathematically optimal.
It wasn't. When asked why, he said he wanted to minimize future regret. He visualized the pain of losses in a bear market and chose a strategy that helped him sleep at night, not the one his own models dictated. His strategy, he admitted, was reasonable.
So the rational investor uses spreadsheets. The reasonable investor considers their emotions and life context.
Exactly. A rational investor makes decisions based purely on numbers. A reasonable investor makes them in a conference room with colleagues they want to impress, or with a spouse they don't want to disappoint, or just acknowledging their own fears and biases.
So things like buying a slightly more expensive house in a safer neighborhood, even if it's not rational for maximizing financial returns, makes sense for some because it buys peace of mind. That's reasonable.
Perfectly reasonable. Or home bias in investing favoring local companies or familiar brands. Rationally, you're missing global diversification, concentrating risk.
But it feels safer, more comfortable.
Right. And that psychological benefit of familiarity might keep you invested through market turbulence, which is ultimately more important than an optimal but untenable strategy.
Even day trading small amounts for fun.
Housel mentions that too. Maybe you keep 99% of your portfolio in diversified index funds, but you scratch that itch with 1%. Is it rational? No. Is it reasonable if it keeps you from messing with the core portfolio? Maybe.
Like investor Josh Brown saying he owns some individual stocks just because he loves stocks.
Exactly. Being reasonable helps you stick to a plan long term, which, as we discussed with compounding, is the most important thing. Even Jack Bogle, the saint of low-cost indexing, put some money in his son's high-fee active funds. Why? We do some things for family reasons. If it's not consistent, well, life isn't always consistent. Reasonableness wins.
We've talked about how life is full of surprises and plans rarely go perfectly. Housel's solution to this inherent unpredictability: build in room for error.
Yes, margin of safety. He says it's the most important part of any plan. Planning for the plan not to go according to plan.
How does that work in practice?
He uses the example of Kevin Lewis, a famous card counter for the book Bringing Down the House. Lewis explained that even when you know you have a statistical edge in blackjack, you still need enough money, a big enough bankroll, to withstand the inevitable streaks of bad luck.
You can still lose many hands in a row, even if the odds are slightly in your favor.
Exactly. He suggested having 100 basic betting units. This margin of safety, this buffer, isn't just about being conservative. It's about increasing your odds of survival long enough for your edge to play out. It lets you stay in the game.
And it comes in many forms.
Many forms. A frugal budget, flexible thinking, a loose timeline for goals, diversified investments. Its magic is that the greater your margin of safety, the less precise your forecasts need to be, and the less your edge needs to be for you to still have a favorable outcome over the long run.
Bill Gates famously ran Microsoft with enough cash in the bank to cover a year's payroll, even if no payments came in. That's a huge margin of safety.
Massive. And Warren Buffett prioritizes sleep. over chasing extra gains, saying he wouldn't trade a night's sleep for the chance of extra profit. That's a psychological margin of safety.
This applies directly to investment volatility too, right? Can you handle a big market drop?
Not just financially, but mentally. Can you truly survive a 30% market drop without panicking? It's easy to say you can when things are calm, but it's much harder in the moment. Your confidence can evaporate just when investment opportunity is actually highest.
So how do you build a margin of safety there?
For retirement savings, for example,
Huh?
simply assuming lower than historical returns in your projections builds a critical margin of safety against unexpected events or just plain bad market performance. Gives you wiggle room.
It links back to Taleb's idea. You can love risk and yet be completely ruin averse.
Exactly. Take risks? Absolutely. That's often how you grow. But never take any risks that could wipe you out completely.
So the key is to take smart risks, but never any that could take you out of the game.
Precisely. And leverage borrowing money to invest is often the devil here, as Housel puts it.
Why leverage specifically?
Because it turns routine, manageable risks into potentially ruinous ones. When housing prices dropped 30% last decade, it wasn't a disaster for everyone. But it became catastrophic for those who had taken on high leverage, high mortgages relative to their home's value. They got wiped out.
So a good rule of thumb, anything that can break eventually will.
Assume it will. Avoid single points of failure. Your sole reliance on a paycheck for short-term expenses with no savings buffer. That's a major single point of failure.
And that's saving just because.
That protects against those unknown field mice, those unpredictable events that could otherwise derail your entire financial life. Room for error is your shield against the inevitable surprises.
Okay, this next one feels crucial for long-term planning. The reality that we change, our goals, our desires, they shift profoundly over time.
This is a big one. The end of history illusion.
Housel brings up that poignant story of his friend who struggled against all odds, worked incredibly hard to become a doctor,
Yeah, achieved the dream.
only to find himself years later completely miserable in the profession, telling Housel, "Horrible career, man."
It's heartbreaking, but so common. It's that end of history illusion in actions. Psychologists find we tend to believe that the person we are today is the person we'll be forever. We think we're done evolving.
But our future selves inevitably have different priorities, different values.
Absolutely. Many of us go through multiple career changes, different life stages, single, married, kids, empty nest, and fundamental shifts in what we truly value. Consider that only 27% of college graduates have a job directly related to their major.
Wow, that low.
That low.
Yep.
And 29% of stay-at-home parents have a college degree. Few regret their education. But our 18-year-old career goals rarely align perfectly with our priorities at 30 or 50 or 70. We change.
So, how do you compound wealth effectively, which requires immense consistency and sticking to a plan for decades when you yourself are constantly changing? Charlie Munger says the first rule of compounding is never to interrupt it unnecessarily.
It is incredibly difficult. It's a real paradox. People like Ronald Read and Warren Buffett succeeded partly because they did keep doing the same thing with the same mindset for decades and decades. They were consistent because they didn't change much in that regard.
That's rare.
That's very rare. For most of us, life is far more like maybe 4 distinct 20-year blocks, each with shifting priorities, maybe different careers, different family situations. The challenge then becomes, how do you maintain that long-term compounding when your financial goals and even your personality might change drastically over time?
The key then for most of us is probably to avoid financial extremes at any given point.
That seems to be Housel's recommendation. Avoid extremes.
Like being so radically frugal in your 20s that you're unprepared financially or psychologically for starting a family later. Or working such insane hours chasing money that you wake up at 50 regretting missing your youth and your kids growing up.
Precisely. Balance at every point in life fosters resilience and minimizes future regret. Extreme plans, whether for radical simplicity or exorbitant luxury, often lead to regret down the road. Why? Because the initial benefits often disappear as you adapt to them.
Hedonic adaptation.
Right. But the downsides, like not being financially prepared for an unexpected turn or missing out on key life experiences, those can linger painfully.
So moderation is key.
Moderate savings, moderate free time, a moderate commute, moderate family time. These strategies dramatically increase the likelihood of sticking to a financial plan long-term, simply because they are more adaptable to the changes life throws at you and the changes within you.
And crucially for you, the listener.
Accept the reality of changing your mind.
Mm.
Don't be held prisoner by past decisions or sunk costs. If a path isn't working for you anymore, change it. As Daniel Kahneman's editor famously said to him when Kahneman would scrap entire chapters and start anew, "I have no sunk costs."
Abandon plans that no longer fit your life and recompound your efforts as quickly and effectively as possible on a new path.
That's the way to navigate change.
Okay, let's shift gears a bit to understanding market dynamics and how our human nature influences them. This next section has a truly provocative title. Tails, you win.
Huh. Yeah, it sounds like something right out of a casino, doesn't it?
It does. What's he mean by that?
It's about the extraordinary, disproportionate influence of what are called tail events. These are the far, often extreme ends of a distribution of outcomes. Think outliers.
Okay.
These outliers, Housel argues, drive the vast majority of results in finance and business. He shares the story of the art dealer Heinz Berggruen.
Fled Nazi Germany, became hugely successful.
Hugely successful. He acquired vast quantities of art, maybe 99% of which turned out to be of little long-term value, but the tiny 1% that turned out to be by masters like Picasso or Klee, that made him fantastically wealthy.
So he operated, in essence, like an index fund for art.
Exactly. He could be wrong most of the time and still end up spectacularly right because the wins were so massive, he understood the power of tails.
Like Walt Disney. His first studio went bankrupt, right? And most of his hundreds of early cartoons actually lost money.
That's right. Constant struggle. But then came Snow White and the Seven Dwarfs.
The big one.
The massive tail event. It earned $8 million in its first 6 months back in 1938, an unheard of sum then. It paid off all his debts, funded a brand new studio in Burbank, and turned Walt from famous into a full-blown global icon. One hit transformed everything.
So a single tail event can truly account for the vast majority of returns?
It really can. Look at venture capital. There was a study by Correlation Ventures analyzing over 21,000 venture fundings between 2004 and 2014.
Okay, what did they find?
A staggering 65% of those investments actually lost money.
Wow, 2/3 failed.
Yeah. But a tiny fraction, just 0.5%, about 100 companies out of 21,000 generated 50x returns or more. And those few massive winners accounted for almost all of the venture industry's profits. The tails wagged the dog.
But this also happens with publicly traded stocks, doesn't it? Not just high-risk startups. You might think big, established companies are safer bets.
Astoundingly, yes, the same dynamic applies. J.T. Morgan Asset Management looked at the Russell 3000 index. That's the vast majority of investable U.S. stocks from 1980 to 2014. They found that 40% of all those companies lost at least 70% of their value and never recovered. 40% were catastrophic failures over the long term.
That's huge. So where did the index returns come from?
Effectively, nearly all of the overall index returns during that long period came from just 7% of the companies, the extreme winners, that significantly outperformed. Most publicly traded companies, it turns out, actually have a lifespan measured in years or maybe a couple of decades, not generations. The winners are rare, but their impact is enormous.
Like Amazon, for instance. Its phenomenal growth isn't evenly spread across all its ventures. It's overwhelmingly driven by just two key tail events within the company, right?
Exactly. Prime and Amazon Web Services, AWS. Even though Amazon experimented with hundreds of products and services, many of which failed, like the Fire Phone.
Right, the Fire Phone flop.
Those two massive successes, Prime and AWS, carried the entire company and generated most of the shareholder value. They were internal tail events.
So what does this mean for us as investors if most things fail or don't do well?
It means it's completely normal expected, even for many things to fail, break, or go wrong in your portfolio or in business. That's why Jeff Bezos famously says Amazon is working on much bigger failures than the Fire Phone.
Because failure is necessary to find the wins.
Yes, and why Netflix CEO Reed Hastings actively pushes for a higher cancellation rate for their shows. They understand. You have to take more swings, accept more misses, to find those rare but incredibly powerful tails that drive disproportionate success. It's an intelligent recognition of how this dynamic works.
So, this idea of tails you win isn't just for VCs, it's fundamental for average investors too. How does truly understanding that most things will go wrong, yet a few big successes make all the difference? How does that change how we approach building a portfolio and our mindset during market downturns?
It fundamentally shifts your focus, or it should. Instead of trying to pick every single winner or panicking when an individual investment underperforms.
Which is easy to do.
So easy. Instead, you focus on simply staying broadly diversified and, crucially, staying invested long enough to let the outliers, the winners, work their magic. It gives you psychological permission for many of your investments to underperform or even fail because you understand that's simply part of the game.
Peter Lynch said something about this, right?
Yeah, Peter Lynch, one of the best mutual fund managers ever,
Yeah.
famously said that in investing, if you're great, you're right, maybe 6 out of 10 times.
Only 6 out of 10 for one of the greats.
That's what he said. It's not about being perfect all the time. It's about how much money you make when you're right and how much you lose when you're wrong. The magnitude matters more than the frequency.
Housel has that example about saving $1 a month.
Great illustration. If you save just $1 a month from 1900 to 2019 and consistently invested in the U.S. stock market through all the crashes, wars, everything,
Okay.
you'd end up with $435,551. But if you tried to time the market, only investing when the economy was not in recession, selling out during downturns, and only buying back after things felt safe again,
How much would you have then?
only $257,386.
Wow, almost $200,000 less just from trying to avoid the downturns.
Exactly. Simply staying calm and invested during the 22% of the time the economy was in or near recession yielded almost 3/4 more money. The magic is in endurance, in letting the tails work, not in perfect timing.
Okay, next big idea. Surprise. Housel says history is the study of change, but we ironically use it as a map for the future. He states, things happen all the time that have never happened before.
Yeah, that Scott Sagan quote perfectly captures it. Things that have never happened before happen all the time. Investing isn't a hard science like geology or medicine where phenomena behave consistently over time.
Right. Gravity always works. Diseases behave in predictable ways.
But investing, it's a massive, complex group of flawed human beings making imperfect, often emotional decisions based on incomplete information. That makes it inherently unpredictable. We cannot treat historians as prophets for future market behavior.
So relying on historical averages for future returns, which many financial plans do, can be deeply misleading.
Yes, absolutely. Because the most significant events in history, the ones that truly shape the future, are by definition the record-breaking outliers. They're the surprises.
Like the Great Depression, WWII, 9/11, the dot-com bubble.
Exactly. These weren't just slight deviations from the average. They were unprecedented events. Housel makes the point that a tiny percentage of people or events are responsible for the vast majority of the world's direction or economic shifts. Think about the impact of maybe a handful of individuals in the 19th and 20th centuries. Hitler, Stalin, Edison, Gates, Martin Luther King Jr. Their actions shaped outcomes for billions.
A tiny number with massive tail effects.
And these extreme events often compound in incredibly unpredictable ways. That chain reaction Housel traces is mind-boggling.
You mean 9/11 leading to student loan debt?
Yeah. 9/11 happens. The Fed cuts interest rates to stimulate the economy. Low rates help fuel the housing bubble. The housing bubble bursts, causing the 2008 financial crisis. The crisis leads to massive job losses, particularly for young people.
Okay, following so far.
Millions of unemployed or underemployed young people decide to go back to college or grad school, seeking refuge from the bad job market. This surge in demand allows colleges to raise tuition fees dramatically. And the result? $1.6 trillion in student loan debt.
Wow. It's genuinely counterintuitive to connect 19 hijackers to the student loan crisis, but you can see the domino effect.
That's precisely how a world driven by extreme, unprecedented events operates. We can't predict them because they are, by definition, unprecedented. They haven't happened before.
Which means assuming future worst-case scenarios will simply mirror past worst-case scenarios is fundamentally flawed.
It is. The problem is that structural changes in the economy and financial system make direct historical comparisons misleading. The 401k didn't even exist 50 years ago. Venture capital barely existed 25 years ago in its modern form. How can we use 100 years of data to predict systems that are brand new?
Even Benjamin Graham, the father of value investing, admitted this near the end of his life.
That's right. His detailed formulas for stock analysis, revered for decades, he said they were no longer as relevant as they were 40 years prior.
Why? What changed?
Competition grew immensely. Technology made information instantly accessible to everyone. Entire industries shifted from manufacturing to tech and services. The game changed.
So the further back you look in history,
The more general your conclusion should be. Focus on the constants. Human behavior, greed, fear, optimism, tribalism. That stuff is pretty stable over time. But specific trends, market dynamics, industry leadership, those are constantly evolving.
So that dangerous phrase, it's different this time.
It's often mocked, right? But Housel points out, quoting Sir John Templeton, that it is different at least 20% of the time. History is a guide, not a map. Pessimists often forget that problems inherently incentivize solutions, too.
Like the 1970s oil crisis.
Exactly. That crisis directly led to innovations in drilling, eventually leading to fracking and a huge surge in U.S. oil production decades later. Threats often incentivize solutions and lead to unexpected progress. It's easy to assume something ugly will stay ugly, but the world adapts. Surprise.
Okay, following on from surprises, Housel makes a powerful point. Everything has a price. And often, the true price of investing isn't obvious until it's actually due. It's not just the dollars you put in.
Right. He asks, do you want the potential for, say, 11% annual returns over 30 years, like the U.S. market historically provided?
Sounds great. Where do I sign up?
Well, the price isn't just the money you invest. It's enduring, as he puts it, endless mockery from the market, which gives big returns and takes them away just as quickly.
Ouch. Mockery from the market.
Think about the Dow Jones Industrial Average. It returned that impressive 11% annually from 1950 to 2019. But get this, it traded more than 5% below its previous all-time high for over 90% of those days.
90% of the time, it felt like you were losing or underwater from the peak.
Pretty much. That's the cost of admission for those long-term returns. The volatility, the uncertainty, the drawdowns, that's the price you pay.
He uses GE's stock as another example, right? The illusion of smooth sailing.
Yeah, GE was famous for consistently hitting its quarterly earnings targets, smooth as silk. Investors loved it. But it turned out that previous CEOs had been essentially massaging the numbers, pulling forward future earnings to avoid any short-term pain or volatility.
So they were avoiding paying the price up front.
Exactly. But the bill eventually came due with a vengeance. The stock plummeted from $40 in 2007 to $7 by 2018. A decade of gigantic losses because the real price hadn't been paid along the way.
So volatility isn't a bug in the system. It's a fundamental feature. It's the price you absolutely must pay for the potential of higher long-term returns.
Exactly. It's not a fine for doing something wrong. It's the fee for accessing the potential gains.
Mm,
And many investors, maybe subconsciously, try to get the returns without paying that price.
like market timers.
Like market timers or people chasing tactical mutual funds that promise upside participation with downside protection. They try to be in during the good times and out during the bad.
Does it work?
Morningstar studies consistently show they largely fail. They often underperform simpler, cheaper buy-and-hold strategies. By trying to avoid the price volatility, they frequently end up paying double in missed gains or higher fees.
Look at Netflix or Monster Beverage.
Two of the highest returning stocks of recent decades, creating incredible wealth. But guess what? They traded below their previous all-time highs for 94–95% of the time during their massive growth periods. That constant, gut-wrenching volatility was the price of admission for those spectacular returns.
So the key psychological shift is to stop thinking of market volatility as a fine or a penalty for making a mistake,
Right. Stop blaming yourself or the market.
and start thinking of it as a fee, a necessary expected cost for a valuable service like long-term growth potential.
That perspective is truly transformative. It changes everything emotionally.
You pay $100 for Disneyland tickets because you anticipate getting an amazing experience in return. You don't see the ticket price as a punishment.
Exactly. You happily pay the fee because you value the outcome. Similarly, volatility is the cost of admission for market returns. You're not obligated to pay it. You can stay in cash or bonds for lower, more stable returns.
Yeah.
But if you want the potential magic of long-term equity growth, you must accept the fee.
And viewing it as a fee makes it easier to endure.
Much easier. Few investors are willing to openly say, I'm actually fine if I lose 20% of my money.
With you?
But if you view that potential 20% drop as the fee you might have to pay for the chance at much higher long-term gains, it fundamentally changes your emotional response and helps you stay invested when things get scary.
This leads right into another critical point: understanding your own game. We often fall into the trap of assuming other investors have the same goals and time horizons as us.
And this can lead to disastrous decisions. Housel notes that asset prices can actually appear completely rational, even during apparent bubbles, if you consider that investors have wildly different goals and time horizons. Think about, how much should you pay for Google stock today?
Depends who you ask, right?
Exactly. It depends entirely on who you are and what game you're playing. Are you investing for the next 30 years for retirement? The next 10 years for a house down payment? Or are you a day trader just looking to make a profit by lunchtime?
They'll all have completely different ideas of what a reasonable price is.
Completely different criteria for valuation, completely different sensitivities to short-term news.
So the dot-com bubble, for example. From a long-term value investing perspective, The prices were insane, irrational.
Absolutely detached from fundamentals.
But from the perspective of a short-term trader just riding momentum,
It might have been perfectly rational for them. They didn't care about 10-year earnings potential. They only cared if the stock was likely to move up in the next hour or day or week based on crowd psychology.
so bubbles often form when the players change.
Correct. Bubbles often inflate when the momentum of short-term returns draws in so much money that the very composition of investors shifts from predominantly long-term holders to predominantly short-term traders. The person setting the marginal price in the market becomes the short-term speculator.
Then the long-term investors who jump in late.
They're playing a different game using the wrong rules. They get hurt when the short-term momentum inevitably fades and prices crash back towards fundamentals. It's like showing up for a poker game but thinking you're playing chess.
Like those people flipping houses during the 2000s housing bubble.
Perfect example. They didn't care about long-term price-to-rent ratios or affordability. They only cared that the price would likely be higher next month, allowing them to sell for a quick profit. They were playing this short-term momentum game.
It's like when a commentator on CNBC tells you to buy a certain stock.
Right. Who are they talking to?
They have no idea who you are listening. You might be a teenager saving for college, an elderly widow living on a fixed income, or a hedge fund manager trying to shore up their quarterly performance. Their advice is generic because they don't know your specific game.
And this inability to truly comprehend that other people have different goals and constraints is a powerful, often subconscious anchor in financial psychology. It trips us up constantly.
It also drives consumer spending, right? Social comparison.
Intensely. We see what others buy: the car, the vacation photos, the house renovation, but we don't see their underlying goals, their income, their career pressures, their hidden motivations, or their mountain of debt.
We might try to keep up with the lawyer's spending.
Without realizing, they might feel pressure to maintain a certain professional appearance that doesn't apply to our own careers at all. Most consumer spending, especially in developed countries beyond basic needs, is in fact socially driven. We're signaling.
So, what's the ultimate takeaway here for us, the listeners? How do we avoid getting sucked into playing someone else's game?
First, understand your own time horizon. Are you investing for 5 years or 50 years? Second, and crucially, define the specific game you are playing. What are your goals? What's your risk tolerance? What's your definition of success?
Housel advises actually writing it down.
Yes, write it down. And then this is the hard part. Consciously ignore everything else. Ignore the noise, ignore the pundits, ignore what your neighbor is doing if it doesn't align with your game.
Protect yourself from being persuaded by people playing a different game.
Exactly. The main reason people get into financial trouble, Howells argues, isn't necessarily bad luck or lack of intelligence. It's simply not knowing what game they're playing in the first place.
Okay, related to ignoring noise, Housel points out something fascinating. People like to hear that the world is going to hell. Pessimism seems incredibly persuasive, much more than optimism.
It's absolutely true, isn't it? There's a certain allure to pessimism. Housel cites a 2008 Wall Street Journal article that seriously discussed a Russian professor's prediction that the U.S. would literally break into 6 pieces by 2010.
That sounds completely absurd now.
Utterly absurd in hindsight. But at the time, during the depths of the financial crisis, it played on anxieties and gained significant traction. Bad news simply captures our attention more effectively.
It feels more urgent.
More urgent, more actionable maybe? Think about it. If an intelligent person predicts a stock will tenfold, we're often skeptical, right? Dismiss it as hype.
Yeah, sounds too good to be true.
But if someone, even a known fool, says a popular stock is about to collapse due to fraud or disaster, we listen intently. We might even feel a little thrill of impending doom.
So the financial media definitely knows this. That's why so many investment newsletters focus on disaster scenarios. Because fear sells.
Fear sells. Hope sells too. But fear often sells better and faster. Economic pessimism appears in newspapers tens of thousands of times. Progress, on the other hand, is typically slow, incremental, almost invisible day to day.
Like watching paint dry versus watching a bomb go off.
Exactly. Setbacks are fast, sudden, dramatic, impossible to ignore. A 1% market drop is splashed in bold red headlines. A 1% gain might be a tiny mention buried on page 1D.
This means it's inherently easier to construct a compelling narrative around pessimism.
Yes, pessimistic narratives are often easier to build because the negative events are fresh, dramatic, and evoke strong emotions. Optimistic narratives, by contrast, require looking at long stretches of history, showing slow progress and compounding, which people tend to forget or find less exciting.
And pessimism often overlooks adaptation.
Crucially, yes. Pessimists often extrapolate current problems indefinitely into the future, forgetting that problems inherently incentivize solutions. The 1970s oil crisis led to drilling innovations and fracking. High energy prices spurred efficiency gains. Threats often incentivize solutions and lead to unexpected progress. It's easy to assume something ugly will stay ugly forever, but the world adapts. Optimism is often the most rational long-term stance, even if pessimism feels smarter short-term.
This connects directly to how we consume and interpret information, especially when we're feeling stressed or desperate. Housel makes a powerful, almost sobering statement. The more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true.
Oof. Yeah, that cuts deep. It's what he calls an appealing fiction.
When does this emerge most powerfully?
It emerges when the stakes are high, you feel you have limited control, and you're desperate for a solution. You become susceptible to stories that offer hope, even if they're unrealistic.
He shares that tragic story of Ali Hajaji.
Yeah, the Yemeni father, whose young son was very sick, lacking access to proper medical care, he allowed the son to undergo a traditional folk remedy involving, well, pressing a burning stick through the child's chest.
Oh my God, that's horrifying.
It's horrifying. But Hajaji's heartbreaking explanation was simple. When you have no money and your child is sick, you will believe anything. Anything that offers even a sliver of hope.
It sounds like dangerous quackery from our perspective, but in times of desperation, people cling to any perceived lifeline.
Absolutely. Think about the Black Death in medieval Europe. It led to a surge in belief in wild astrological prophecies and absurd, often dangerous remedies. People were desperate.
And in finance, how does this believing anything manifest?
It explains why people listen to investment commentators with consistently terrible track records, or why they buy into get-rich-quick schemes, or, famously, why so many intelligent, sophisticated people fell for Bernie Madoff's elaborate Ponzi scheme.
He told a good story.
He told a great story. Consistent returns, month after month, year after year, regardless of market conditions. It was exactly what people wanted to believe, especially wealthy investors who perhaps felt they deserved exclusive access to steady, high returns. The appeal of this story overrode skepticism for many.
So the implication is that because investing inherently offers the daily possibility of extreme rewards, people are perhaps more susceptible to financial charlatanry than in other fields.
Precisely. The potential payoff is so huge, the desire so strong, that it makes us vulnerable to appealing fictions. This makes the things we discussed earlier, margin of error, flexibility, financial independence, even more indispensable. They protect you from needing to believe in miracles.
And it ties into our incomplete view of the world.
Yes. Everyone, no matter how smart, has an incomplete picture. But our brains automatically construct a full narrative to fill in the gaps. Like a toddler explaining her world based on very limited information, we do the same as adults. This can lead to overconfidence in our ability to predict the future or to completely misinterpret other people's actions because we assume they're playing the same game as us with the same information we have. We build stories to make sense of things, even if the stories aren't accurate.
Okay, we've covered a lot of ground today exploring this fascinating behavioral side of money. Housel shifts here towards the end, emphasizing that there's truly no universal right answer in finance.
Yeah, it's not one size fits all.
Instead, it's about finding what works specifically for you, for your psychology, your goals, your life.
This concept actually mirrors the evolution of medicine. It used to be very paternalistic, right? Doctors dictated treatment. Take this pill, have this surgery.
Doctor knows best.
Exactly. But medicine evolved toward shared decision-making. Physicians realized that while there are universal truths about diseases, patients have vastly different perspectives on what's truly worth it in life. The side effects, the recovery time, the impact on quality of life.
There was that court case in 1931.
Right, where a surgeon removed a patient's tonsils and 16 teeth without specific consent, arguing the doctor needed freedom to make decisions for science to advance. Thankfully, we moved past that. We now recognize patients have varying goals for treatment, even if it means a technically less optimal medical outcome, according to the textbook.
So applying that to finance, a good financial advisor shouldn't just tell you exactly what to do, dictate the optimal portfolio.
No, because they can't possibly know your deepest goals, your fears, your unique desires, or your specific timeline. They don't know what helps you sleep at night.
They can guide, provide options, explain trade-offs, but the decision is ultimately yours.
Exactly. There are fundamental, universal financial truths: save money, diversify, be patient, but their application varies tremendously from person to person. Housel offers a powerful set of humble, actionable recommendations that weave together all these insights.
Okay, let's run through some of them.
First, embrace humility in good times and compassion in bad. Remember, nothing is ever as good or as bad as it seems. Luck and risk are real. Focus on what you can control.
Good one. Less ego, more wealth.
Yes, true wealth is unspent income. It's a direct result of controlling your desire to spend now, which gives you more options and flexibility later. Tame the ego.
Prioritize a good night's sleep.
Make financial decisions that let you sleep soundly, even if they don't maximize returns on paper. Peace of mind is priceless.
Increase your time horizon.
Time is the most powerful force. It makes small things grow huge and big mistakes fade. Think long term.
Get comfortable with things going wrong.
Expect many things to fail or underperform. Remember, success usually comes from a few disproportionately large wins the tails.
Use money to control your time.
That's the highest dividend money pays. Aim for autonomy.
Be kinder, less flashy.
Valued relationships and genuine respect come from kindness and humility, not from showing off possessions. Nobody cares about your stuff as much as you do.
Save, just save.
Save without a specific goal sometimes. It's that invaluable hedge against life's inevitable, unpredictable surprises.
Define and accept the price of success.
Volatility and uncertainty are the fee for market returns, not a fine. Accept it, pay it willingly if you want the potential reward.
Build in room for error. Margin of safety.
Absolutely. Plan for your plan to fail. It builds resilience, ensures survival.
Avoid extremes.
Your goals and desires will change. Seek balance at every point in life to foster resilience and minimize future regret.
Embrace risk, but fear ruin.
Take smart, calculated risks, but never any risk that could wipe you out completely. Avoid that single point of failure.
Define your game.
Clearly understand your objectives, your time horizon. Don't be influenced by others playing different games.
And finally, respect the mess.
Yes, except that smart, informed people can disagree fundamentally on financial decisions because finance is complex, personal, deeply psychological. There truly is no single right answer for everyone.
Housel closes his book with a truly personal confession of his own financial philosophy. It really does make this feel like a custom-tailored deep dive, doesn't it? Offering a glimpse into how these principles are applied in his own real life.
It does. It grounds all the theory. And his core goal: independence. Not just being rich in terms of numbers, but having independence.
Meaning what, exactly?
Meaning having the ability to do what he wants, when he wants, with whom he wants, for as long as he wants, completely on his own terms. Being able to wake up one morning and decide to change what you're doing. That, to him, seems like the grandmother of all financial goals.
He mentions his parents as an example.
Yeah, they became moderately wealthy after a period of being very poor, but they never really changed their lifestyle. They maintained a frugal mindset, saved heavily, which allowed his father to eventually retire from a stressful emergency room job whenever he chose to, not when he was forced to. That control was key.
So for Housel personally, maintaining a high savings rate, keeping expectations for lifestyle inflation firmly in check,
Keeping those goalposts from moving.
and finding genuine joy in simple, low-cost activities like walking and reading are key components.
That's right. He also shares some specific choices that might seem irrational on paper.
Like owning his home outright.
Exactly. Even though financially, holding a mortgage with a low interest rate might be more rational, allowing him to invest the difference, the psychological independence and peace of mind of having absolutely no monthly housing payment far outweighs the potential missed financial gain for him.
And he keeps a lot in cash too, right?
Yeah, he confesses to keeping a relatively high percentage of assets in cash, maybe around 20%, which is also not rational for maximizing long-term returns according to standard models. He openly admits these are decisions that are hard to defend on a spreadsheet.
And why does he do this if it's not rational? What's the reasonable explanation?
Because, as he puts it beautifully, cash is the oxygen of independence.
The oxygen of independence. I like that.
It ensures that he and his family are never forced to sell their stocks or other investments at an inopportune time, like during a market crash, just to cover unexpected expenses. It allows their long-term investments to sit tight and compound uninterrupted, regardless of short-term volatility or life events.
Guarantees survival, basically.
It guarantees survival and prevents forced errors. He holds a deep belief that there's actually very little correlation between investment effort and investment results, precisely because the world is so driven by unpredictable tales. He doesn't feel the need to be the greatest, most active investor.
He just needs to be consistent and avoid big mistakes.
Exactly. He just needs to consistently invest in low-cost index funds over decades, live relatively frugally, and, crucially, ensure he can never be forced out of the game. That's his ultimate goal. Simply to avoid being a bad investor, which allows his family to meet all their financial goals without needing to take on excessive risk trying to beat the market. It's about durability.
So, wrapping this all up, what does this mean for you, the listener? This deep dive into the psychology of money has really revealed that true financial success isn't just about what you know, the numbers, the
No,
strategies.
it's profoundly about how you behave.
It's about understanding the powerful, often invisible forces of luck, risk, compounding, and your own evolving psychology that truly drive your financial life.
It's a powerful reminder that wealth isn't just about accumulating more and more stuff or hitting a certain number. It's about finding your own definition of enough.
It's about valuing freedom and control over your time more than flashy possessions.
And embracing resilience, building in that room for error, because life will surprise you. The financial world is messy, it's complex, and it's deeply personal.
The provocative thought we want to leave you with today is this. In a world that's constantly trying to convince you that happiness comes from acquiring more, how much of your financial energy are you truly devoting to what you genuinely want versus what you think others expect of you?
And maybe ask yourself, are you willing to genuinely pay the real price of your financial goals? The price of volatility, uncertainty, patience, and delayed gratification, not just the obvious price tag.
As you continue your own unique financial journey, maybe pause and consider, which game are you playing? What are the rules you set for yourself?
And how can you ensure your actions truly align with your personal definition of wealth, happiness, and independence, rather than getting caught up in someone else's game?
Thank you for joining us on this deep dive. We hope these insights help you navigate your own financial world with greater clarity, confidence, and maybe a little more peace of mind.